Hello, I'm David Frazier, aka the Market Monk. Well, we got some more entertainment today, early this morning at least, off or out of the major financial broadcast shows. When I was waiting for the U.S. government's Department of Commerce to release figures on Q1 GDP, gross domestic product, that is the total output of goods and services in the United States for the 3 months ended March 31st. The anchor person that I was listening to, within a few seconds after the Department of Commerce announced that GDP had risen extremely modestly at a very, very slow pace during the first quarter. Well, this guy went in and started talking about a double-dip recession. Could there be a double-dip recession? And actually, I'm going to help that person out a bit and say, no. I'm going to answer his question directly for him and for you, our listeners, and that is, no, there can't be a double-dip recession. As a matter of fact, that's an impossibility. That cannot happen. And why can that not happen? Because a double-dip recession refers to a recession that occurs within a relatively short period of time of a preceding recession. And usually, there's no specific definition, but in general terms, it would refer to 2 years or less of a previous recession. Well, the last recession ended in June of 2009. So there's no way, it's an impossibility for there to be a double-dip recession. But, this broadcaster, he wasn't interested in educating or informing his listeners. He was interested, as many of these outlets are, primarily in telling a story and touching upon the emotions of the listeners instead of trying to give some good information and facts that might actually help investors and financial market speculators to make money. Secondly, my research indicates very strongly, and you would hope some of these guys would do some research, or at least that their staffs would do some relevant research, and that is, my research indicates strongly, very, very, extremely strongly. In fact, it's overwhelming. There's not going to be another recession anytime within the next at least 18 months to a couple of years. I mean, the data is overwhelming, showing that just the opposite is going to very likely to occur, and that is that the pace of economic growth here in the United States, since that's the country we're talking about at the moment, will increase during the months ahead. But, once again, so that's, I point this out to try to get you, our listeners, accustomed to the fact that we here at Frazier and Mayer Research LLC, doing business as themarketmonk.com, we focus on the facts, and we talk about factors and developments that actually will likely affect the value of your portfolio, rather than trying to touch upon your emotions and to get you to watch just because you're really scared about something or you get really greedy. Okay, having said that, today's GDP report really wasn't very surprising at all to me, and what it showed was that economic output in this country did increase extremely modestly during the first quarter of this year as compared to the prior quarter. And if one were to take the increase in output during the first quarter versus the prior quarter, and then multiply that times 4 to get an annualized rate, well, GDP grew at only 0.1% in the first quarter compared to the last quarter on an annualized basis. Well, first of all, that's a pretty ridiculous way to talk about GDP anyway, even though economists do this all the time. This is what this is almost, I've never heard any other economists talk about what seems to me much more important, and that is looking primarily at the year-over-year changes from one quarter to another, instead of just from one quarter versus the previous quarter. Now, I also look at the quarter-to-quarter changes, and that's because, sometimes that will get good indication of where we're heading in the very short term. But to annualize those figures, that just doesn't make any sense whatsoever. That's the dumbest thing I've ever heard of, even though economists do it all the time. I mean, it would be synonymous to me measuring the height of my daughter, who's 10 years old, and 3 months from now, measuring her height again, and then taking any change, well, actually 1 month from now would be better analogy, I guess, to measure her height at the end of this month, do it again at the end of next month, and then multiply that change that we would likely experience next month in a period of only 1 month, since she is 10 years of age and growing, and multiplying it times 12 to get an annualized growth rate. Well, that's just utterly ridiculous. It's just nonsense. So, on a year-over-year basis, the total output of goods and services in this country increased 2.3%. That is, if we look at the total output, that is GDP, in the quarter ending March 31st of this year versus the same quarter a year ago, it was up 2.3%. And that's actually a fairly healthy rate of growth. And then if we back up and once again just look at the quarter-to-quarter change that was extremely modest, well, that's not surprising at all. And the reason it's not, we really did have extremely cold weather in this country, in most parts of this country, during the winter months of this year. And that cold weather actually did impact in a negative way construction companies, whether it be home building or construction of commercial buildings, industrial buildings. Negatively impacted industrial output. I mean, this cold weather, it was extremely cold weather, actually did have a big negative effect on economic activity during the first quarter. So, regardless, this is in the past. This is yesterday. This is for the quarter end in March. We're into April now. As I've said before on this show, one doesn't ever make money in the financial markets by simply reviewing what happened in the past. Now, it's good to look at the past. I always look at the past. I mean, I go back generally, I go back many years, 50 to 100 years sometimes, looking at economic data. I've gone back thousands of years and looking at historical data and information to get a good understanding of how people tend to react to different events and developments. But, that's a foundation in its important research, but you're going to make good returns in the financial markets primarily by gauging what is likely to happen in the future, not what has already happened. So I don't really care much about what happened with GDP in the last quarter to begin with. I care about what's likely going to happen during the months and quarters and years ahead. And my research has continued to indicate very strongly, very strongly, that the pace of economic growth here in the United States, as well as in Europe and Japan, is going to increase considerably during the second half of this year. And that's based on reviewing a lot of statistics, a lot of reliable leading economic indicators, that is, economic variables that have shown repeatedly over many years that those economic variables are very good leading indicators of what happens in the overall economy. I mean, we got a really positive report here. When I look to the left, I'm just looking at some notes out of an entity that measures manufacturing activity in the Midwest, and their latest surveys of thousands of purchasing managers at manufacturing companies in the Midwest showed that manufacturing activity increased sharply during March, this past March, as compared to the prior month. And that the pace of economic activity in the manufacturing sector was actually rose at the fastest pace in 6 months. So that's a very positive development, and that's a reliable leading economic indicator. Secondly, we got a report today out of Automatic Data Processing, which does payroll management for thousands of companies in the United States. And ADP, Automatic Data Processing, they also do a monthly review and analysis of job creation or job losses. And they announced this morning that jobs in the private sector of the U.S. economy, that is in sectors other than government jobs, rose, let's see, what do we have exactly here? 220,000 jobs, new jobs, private sector jobs were created in March of this year versus 209 in, that 220,000 jobs were created during April, that is this month, versus 209,000 jobs that were created during March and 193,000 jobs that were created during February. So obviously, the employment situation changed substantially over the past few months. Now, once again, that's still looking in the past, even though it is through this month, through today. But leading indicators for the employment market are also showing some positive trends. One of the leading indicators that I review on a regular basis is the posting of job ads on internet websites. And job advertisements went up considerably during the past month, which indicates that, well, employers plan to continue to increase the sizes of their work staffs. Otherwise, they wouldn't post more jobs advertising, more advertisements for jobs. Now, give me a moment here. Let me look at my notes real quickly. I'm going to go back briefly to today's GDP report. And even though on an annualized basis, that is taking the change in GDP for the 3 months ended March 31st versus the 3 months ended December 31st of last year, then multiplying it times 4, that is on an annualized basis, even though overall output on an annualized basis was up only 0.1%, personal consumption expenditures were up 3%. That's huge. That's very, 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 very positive. And that's because personal consumption expenditures, household expenditures, and individual expenditures on goods and services tends to account for approximately 68% to 70% of the total output of goods and services in the United States. So, that's a sizable increase in personal consumption expenditures. And the reason that GDP was down, gross domestic product was down versus the prior quarter, not on a year-over-year basis, was because business investments in capital equipment fell pretty considerably during the first quarter versus the prior quarter. Once again, that's not surprising to me because of this really cold weather that we had. This is just a period for 3 months. I mean, come on, this is pretty simple to figure out, in my opinion. Given the fact that the economic expectations of U.S. households has risen sharply over the past several months, continued to trend higher, and the fact that the employment situation has showed a lot of positive improvements, well, that suggests that businesses are likely to increase their capital expenditures pretty considerably during the months ahead, especially after one considers that also the second big reason that GDP fell on a quarter-to-quarter basis during the quarter ending March 31st is because inventories had been reduced substantially. There wasn't any substantial new manufacturing of these goods, and therefore retailers and wholesalers had increased their stocks, their amount of goods and services that they put on their shelves. Not services, you can't put services on shelves. The amount of goods that they put in their stores, that they had increased their stocks of those goods, and therefore inventories of manufactured goods still held at manufacturing companies had been deplenished substantially. And well, why is that a positive? Well, it's a positive development because if those manufactured goods have been, the inventories of those goods has gone down quite a bit, which they did during the quarter into March 31st. And there's a lot of evidence showing that the demand for those goods and services is going to increase during the months ahead, such as the employment situation, the expectations of U.S. households, their confidence level regarding the economy, and their outlook for jobs. Well, that tells me that manufacturing companies are going to increase their production considerably during the months ahead. So this is all positive stuff. You know, this I saw more positive information in this GDP report than any negatives. Okay, that was pretty long. You know, I generally try to keep these this daily show only to 10 minutes or less, but I had a lot of important stuff to cover. And you know, the major stock market indices in the United States moved higher again today, modestly higher, but they did move higher. And I'm going to wrap this up by taking reviewing real quickly what the Federal Reserve's Open Market Committee said in an announcement today regarding the economy. And I'm just going to read exactly what they wrote in the report that they issued today. They said, information received since the Federal Open Market Committee, that is the committee that determines interest rate policy here in the United States for the Federal Reserve banks. Information received since the Federal Open Market Committee met in March indicates that growth in economic activity has picked up recently. Well, after having slowed sharply during the winter, in part because of adverse weather conditions, something that I've already been telling you. Let's see, they went on to say that the committee judges that there is sufficient underlying strength in the broader economy to support ongoing improvement in labor market conditions. And I agree completely with that. In light of the cumulative progress towards maximum employment and the improvement in the outlook for labor market conditions since the inception of the Fed's current asset purchase program, printing a lot of money to keep interest rates low, that is, the committee decided to make further measured reduction in the pace of its asset purchases. So it's going to reduce again, starting in May, the amount of U.S. government securities and mortgage-backed securities that it purchases in an effort to keep lending rates at low levels. So, you know, we don't have to read every line about that. That's what they're telling us. However, they went on to say the committee will continue its purchases of Treasury and agency mortgage-backed securities until the outlook for the labor market has improved substantially. And they went on to say that they plan to keep interest rates at low levels for a considerable time after their asset purchase program ends. I hope that makes sense to you. I hope it's not confusing. They're just telling us that, you know, they're going to keep interest rates low for a considerable time, even though they're reducing their purchases. So a lot of good news to report, and I continue to expect stock prices in general here in the United States, in Europe, and in Japan to continue to move higher during the weeks and months ahead, and for stocks prices of companies based in China, Brazil, and India to also move higher during the second half of this year. That's all. I thank you for listening. I'll speak with you again tomorrow.